to give kind of a review of the year, what market would you like to start with?
Oh, I think that the most important one going forward is going to be gold and silver, with silver in the lead. But we've been noting as the year progressed where we are year to date, because everybody's screaming that everything's going to go down because the Fed's in charge and all this stuff. Well, if they're in charge, how come the Bloomberg's up, 13, 14% on the year? And that's a pullback. How come gold is effectively trading right now with an hour to go left in the day before settlement, down $2 on the year? Okay, and silver's up 3 or 4% on the year. And yet, quote, they're fighting inflation. Well, they are fighting inflation. They're fighting a dozen-year inflation bubble that they created with monetary policy, free money, helicopter money, QEs, you name it. And therefore, all that money went somewhere. And investors and asset managers chose to put it in the stock market back in 2009, which actually, from our perspective, made sense because we turned very bullish in March 2009. In fact, 1 week before the low, we said the low will be around 670. Okay, it was 668, 667 S&P. But then that upside didn't just go up for a couple of years. It went up sevenfold over a dozen years in the S&P. It went up 16-fold for the NASDAQ 100. So it was a bubble like we've never seen in U.S. stock market history. Go back to the 1920s through 1929, doesn't compare in terms of how much up was that bull market before it broke. The dot-com bubble didn't have an advance anywhere near like what we've just seen. The real estate bust that occurred in 2007 and 8 didn't have anything like the advance that we've seen over the last dozen years. So we have a major bubble and they've broken it. So they have in fact fought inflation, if you define inflation properly, meaning broadly. When you increase the money supply, it goes somewhere. Well, investors put it there. However, during this year, you can see that has changed because month by bloody month, the stock market stays down. The NASDAQ's down, 30%, S&P's down about 20, gold's unchanged. Well, as we've seen the year progress, gold has gone from up on the year, down on the year. It closed last year at 1828, by the way. So it went up a couple $100 early in the year. Then we went down, unchanged on the year. It went down a couple $100. So it's been up a couple hundred, down a couple hundred. Right now we're right in the middle where we closed a year ago. So some reason, there are good reasons. Some reason, some investors, particularly large asset managers, like gold. And they've been moving money out of stocks and into gold. No, gold isn't beating its chest, but gold isn't going down. And silver is actually up on the year. So I think that's a statement. I think gold knows something. Now, what might it know? That the Fed has broken something so huge that they will have to turn and pivot at some point, probably early in this year, to defend certain key assets that are imploding, at key assets from their perspective. They don't care about corn farmers making money. That's bad. Okay. But making money in the stock market or in muni bonds or the paper prices going up, that's okay with them. Well, anyway, those assets are now breaking, not just the stock market, but the bond markets. Even the U.S. government bond market is imploding, has been imploding. In fact, it started before the stock market did. So they're going to have to at some point come in and defend these, quote, essential assets. The problem is that historically, if you go back and look at the broken bubbles, I named several of them, the Fed did come in. For instance, Bernanke pivoted in 2008, tried to defend the stock market, the real estate arena. They bought mortgage-backed securities. That didn't work because they monopolized the market and turned it into a non-market. And ultimately, the pricing was totally disfigured and chaotic. So they helped implode that market instead of helping it. But they tried to stop the decline, and it didn't work. Why? Because the market ultimately reaches a point at which, if it's created excess, if it's created error in pricing, if those errors have impacted individuals, corporations, municipal governments, state governments, federal governments, in terms of their pricing, their expectations, their spending plans, then those errors get puked out and you can't stop it. It's nature's way of correcting error. And the Fed created it, but they inevitably cannot stop it. Oh, finally, the bubbles quit breaking, but they usually collapse fully. So that's what we expect this time, except this time we note that it is the biggest bubble in U.S. stock market paper asset history. So don't expect the normal. Gold knows that. Gold knows that ultimately central banks will have to pivot back to what they do best, which is print, 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 because they have to defend their government bonds. And I think that's what gold knows. And therefore, it's not waiting for Powell to state that. It knows it's going to come. And we'll see data flows that finally will enhance that. Anyway, that I think is the major event of the year, is that shift in asset pricing. It's been subtle, but favoring gold and silver.